Robert Half, Inc., stock ticker RHI, is a global staffing and consulting company. Founded in 1948, Robert Half is now an $8 billion by market cap HR player that employs more than 16,000 people. The company reports results across three different business segments. Contract Talent Solutions, 63% of fiscal year 2022 revenue. Protiviti, 28%, and Permanent Placement Talent Solutions, 9%. Approximately 80% of the company's revenue is generated in the US, while the remaining 20% is internationally derived. There are many business models out there that are quietly minting money, flying way under the radar. Staffing/consulting, which is what Robert Half does, is a great example of one such business model. Here's how Morningstar describes Robert Half, and I quote, "Robert Half is a leading global staffing firm in a highly fragmented industry. The firm's pricing power should persist given its deep penetration into the small, mid-sized business market. Local and regional staffers can win business on the fringes, but Robert Half's decades of industry knowledge and well-established client relationships are hefty barriers that should keep smaller competitors at bay," unquote. That short description says so much with so few words. The firm benefits from pricing power, consolidation opportunities, industry expertise, and barriers to entry. If all of that isn't good enough already, Robert Half is getting better. Morningstar points out, and I quote, "Robert Half has been shifting to a higher margin business mix. For one, we expect Protiviti's contribution to continue increasing over the next decade and exceed 1/3 of total revenue. Concurrently, the contract staffing segment, the lowest margin business, will decrease in proportion," unquote. We're not talking about an upshift in margins. I like the sound of that. Put simply, providing talent and consulting solutions is an effective, high-margin method for making a lot of money. Robert Half is great at doing this, and it's only becoming greater. That's what sets up the firm for being able to grow its revenue, profit, and dividend for years to come. To date, the company has increased its dividend for 20 consecutive years. That's impressive. It's a better track record than one might initially expect, and it's quite a bit better than a number of other high-profile names out there. The 10-year dividend growth rate is 11.1%, strong. Better yet, there's been noticeable linearity here. Even the most recent dividend raise was 11.6%. And you get to layer that consistent double-digit dividend growth on top of the stock's market-beating yield of 2.5%. That's a pretty nice combination of yield and growth. By the way, this yield is 40 basis points higher than its own 5-year average. With a payout ratio of 38%, this is a well-covered, safe dividend. Yield, growth, safety, consistency. Robert Half checks the boxes. A lot to like here, no matter what kind of dividend growth investor you are. Looking at business growth, Robert Half moved its revenue from $4.2 billion in fiscal year 2013 to $7.2 billion in fiscal year 2022. That's a compound annual growth rate of 6.2%. Good stuff. I usually look for a mid-single digit top-line growth rate from a fairly mature business, and Robert Half is exceeding my expectations. Meantime, earnings per share grew from $1.83 to $6.03 over this period, which is a compound annual growth rate of 14.2%. Incredible bottom line growth from an under-the-radar business. A combination of extensive share buybacks and mild margin expansion propelled excess bottom line growth. For perspective on the former, the outstanding share count has been reduced by 21% over the last decade. We can now see that double-digit dividend growth has been fueled by double-digit earnings per share growth. However, I'd point out that the last 2 fiscal years were unusually strong for Robert Half. EPS doubled between fiscal years 2020 and 2022. The business had been steadily growing before the pandemic hit, but pre-2020 earnings per share growth appeared to have been in a high single-digit range. Still great, just not so breathtaking. Looking forward, CFRE is forecasting a 1% compound annual growth rate for Robert Half's earnings per share over the next 3 years. Honestly, that's a bit strange. I last looked at CFRE's 3-year EPS compound annual growth rate projection for Robert Half back in April. What was it at that time? It was 8%. Moving from 8% to 1% in only a few months on what is supposed to be a multi-year call seems inappropriate to me, and I suppose that's why some investors don't put much value on analyst forecasts. To be fair to CFRA, I think they do a good job of summing up the current situation for Robert Half with this passage, and I quote, "We think staffing placement volume is experiencing a headwind from rising interest rates, bringing about recession fears which cause Robert Half clients to pull back on hiring, even if current business conditions are healthy, which we believe they are, unquote. Indeed, the US economy is humming along, unemployment remains low, and demand for labor is high. All of that bodes well for Robert Half. Okay, moving past the lack of conviction from CFRA, how do we think about that 1% number? Well, beyond issues relating to rising interest rates and employer fears about the economy, unfounded or not, the main thing working against Robert Half, in my view, is the fact that the business is coming off of abnormally high results, and so the comps will be difficult. From that standpoint, I can see a case for near-term pessimism. Indeed, the company's Q2 report, its most recent, showed a 37.5% year-over-year drop in EPS. Robert Half is going through a painful period that will reset numbers back to normal levels. This adjustment will be a painful adjustment over the near term. Once this normalization process is complete, however, Robert Half should be able to get back to business. Based on what the business has been doing for many years now under regular circumstances, that implies something akin to high single-digit earnings per share growth and perhaps slightly higher dividend growth. Keep in mind, trailing 12 months earnings per share, which is what I based the payout ratio upon, already factors in recent dip in Robert Half's business. Even with the dips, the payout ratio, which is below 40%, indicates a healthy dividend. It's entirely possible and even likely that the next dividend raise or two could break from Robert Half's linear dividend growth history and be lower than what long-term shareholders are accustomed to, but I just find it hard to believe that the business is permanently impaired in any way. And so my long-term view here is that Robert Half will remain capable and is already clearly willing to grow its dividend at a high single-digit rate or higher. When you're already collecting a 2.5% yield, that sets up investors for a very nice total return over the coming years, much of which will stem from plenty of cumulative dividend income. Moving over to the balance sheet, Robert Half has a fantastic financial position. The company has no long-term debt. In an environment where interest rates are rising and debt is becoming more expensive to roll over, Robert Half is sitting pretty. Moreover, whereas a lot of companies have been gorging on debt over the last decade, Robert Half ended fiscal year 2022 with a cash position that was more than twice as high as it was 10 years ago. This fortress balance sheet is a huge edge for Robert Half as the business moves through some turbulence. Profitability is excellent. Net margin has averaged 7.8% over the last 5 years, while return on equity has averaged 39.1%. The margin expansion story is worth touching on, as Robert Half's net margin was routinely in the 6% area in the first half of the prior 10-year period. The returns on capital here are very high, and I'd also point out that return on equity hasn't been juiced by debt. It's all pretty remarkable. Fundamentally speaking, this is a terrific business, and with brand strength, a network effect, entrenched relationships, and a built-up database, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Robert Half is highly exposed to economic cycles, as a healthy economy supports demand for workers and hiring activity, and vice versa. Any broad changes in work and/or the workforce could impact the industry and company. Less outsourcing of HR needs would have a negative effect on Robert Half. Technological innovations such as networking sites and AI could disrupt the business model. Most of the company's revenue is derived from the US, but Robert Half does have some modest exposure to currency exchange rates and foreign lands. These risks should be carefully thought over, but the quality of the business has to be part of that same thought process. In addition, with the stock down 14% from its recent high, the valuation looks attractive. The price-earnings ratio is 15.3. Keep in mind, the E in this ratio is based on trailing 12 months earnings per share and has already absorbed recent drops in earnings, and yet it's still this low. This is well below the broader market's earnings multiple. It's also way off of the stock's own 5-year average PE ratio of 17.9. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. Now, this growth rate is at the high end of what I allow for, but I think Robert Half deserves it. After all, the company has delivered consistent double-digit dividend growth for 2 straight decades, a time period that stretches across both the GFC and the pandemic. And the balance sheet is as clean as it gets. Plus, the payout ratio is low even after some normalization in earnings. Again, it's quite possible, even likely, that the next dividend raise or two is modest, Management may choose to be conservative in this environment, and I think that'd be just fine. However, the long-term go-forward setup for Robert Half's dividend growth doesn't seem all that different from what's already taken place over the last 20 years. The dividend discount model analysis gives me a fair value of $103.68. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates RHI as a 4-star stock with a fair value estimate of $94. CFRE rates RHI as a 3-star hold with a 12-month target price of $80. I came out on the high end this time around, but we all see the attractiveness here. Averaging the three numbers out gives us a final valuation of $92.56, which would indicate the stock is possibly 17% undervalued. Here's the bottom line, guys. Robert Half Inc. is an under-the-radar name that is growing rapidly and putting up high returns on capital, all while running without any long-term debt. It's a terrific business. With a market-beating yield, double-digit long-term dividend growth, a low payout ratio, 20 consecutive years of dividend increases, and the potential that shares are 17% undervalued, dividend growth investors looking for an outside-the-box idea could have something very interesting here. And now for a special news announcement. Nike Inc., stock ticker NKE, has not lost a step when it comes to brand power. According to a recent Piper Sandler survey, Nike is still the favorite brand among teens for both apparel and footwear. Nike is a juggernaut whose popularity is unflinching, and it's a monster dividend growth stock for those who can allow the long-term compounding process to play out. Don't forget about Nike. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and am often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.